In 2023, one of BlackRock's funds, $26 billion in assets, quietly told its investors they could not withdraw their money. No collapse, no fraud, no press conference, just a gate. A fund that size, locking the door, in a market most Americans have never heard of. That market is called private credit. It is now worth $3 trillion. And there is a very good chance the company you work for borrowed from it, at terms that looked manageable in 2020 and look very different today. By the end of this, you will understand exactly what private credit is, how it works, and why the loans sitting on your employer's books right now may be the most consequential financial fact about your job that no one has told you. This is not a story about hedge funds. It is not a story about Wall Street bonuses or institutional investors. It is a story about the $3 trillion in debt quietly sitting underneath the mid-sized companies, retail chains, logistics firms, and medical practices that together employ tens of millions of Americans. And it is a story about what happens to the people working inside those buildings when that debt starts to crack. To understand how we got here, you need to go back to 1982. That year, Congress passed the Garn-Saint-Germain Depository Institutions Act, a deregulation bill that loosened restrictions on banks and kicked off 2 decades of consolidation. What followed was a slow but complete transformation of American banking. Thousands of community banks, the ones that had historically lent to regional and mid-sized businesses, began disappearing into mergers. In 1985, there were roughly 18,000 commercial banks in the United States. By 2023, that number had fallen below 4,500. The banks that survived were bigger, more profitable, and far less interested in lending to companies that weren't Fortune 500 clients. The mid-sized business, the regional freight company, the chain of urgent care clinics, the manufacturer with 400 employees, became, in banking terms, too small to matter and too complex to serve. Then 2008 happened. The financial crisis didn't just damage the big banks. It triggered a wave of new regulation designed to stop them from taking on risky loans. The Dodd-Frank Act made it harder, more expensive, and more legally exposed for traditional banks to lend to highly leveraged, mid-sized borrowers. That created a vacuum, and into that vacuum stepped a new kind of lender. Private credit funds, run by firms like Apollo, Ares, Blackstone, and Blue Owl, offered to do what the banks no longer would. They would lend directly to mid-sized companies, skip the regulatory overhead, and charge more for the privilege. The companies accepted because they had few other options. The funds accepted because the returns were exceptional. In 2010, the private credit market was worth roughly $300 billion. By 2024, it had crossed $3 trillion. That is not organic growth. That is what happens when you remove an entire category of lender from a market and replace it with something that operates in the dark. The system wasn't designed to be predatory. It was designed to fill a gap. The predatory part came later. Here is how it works. Imagine you own a logistics company. 600 employees, regional routes, solid revenue. You need $50 million to expand your fleet. You go to a bank. The bank reviews your debt levels, runs its regulatory compliance checks, and comes back with conditions you can't meet or a rate you can't afford. So you go to a private credit fund instead. The fund says yes. Quickly. With fewer conditions. The rate is higher, call it 8 or 9%. But it is floating, tied to a benchmark called SOFR, which in 2020 was sitting near zero. Your effective rate that year is around 4.5%. On a $50 million loan, that is $2.25 million a year in interest. Manageable. You sign. Then the Federal Reserve starts raising rates. Between March 2022 and July 2023, the Fed raises rates 11 times. SOFR goes from near zero to over 5%. Your loan doesn't change. The rate does. That same $50 million loan, same company, same routes, same 600 employees, is now costing you nearly $5 million a year in interest. That is more than double what you budgeted. in 2 years. Now here's the critical difference between this and a bank loan. If you borrowed from a regulated bank and hit financial stress, you have options. You can restructure, renegotiate. The bank has regulatory and reputational incentives to work with you rather than trigger a default that damages their own balance sheet. Private credit funds have no such incentive. They are not regulated the same way. They are not required to restructure. Their investors, pension funds, endowments, university foundations, are waiting on returns. When you can't pay, the fund's options are aggressive. Demand full repayment, seize assets, or force a distressed sale of the company. The business owner has no regulator to call, no bailout mechanism, no public market to refinance into. There is a contract, and the contract was written when money was free. Here is where the system breaks. Private credit funds sold themselves to borrowers, to institutional investors, to regulators as a stable alternative to public debt markets, less volatile, less correlated to stock market swings. A cushion, not a risk. Cushions don't lock their doors. When BlackRock gated that $26 billion fund in 2023, it revealed something the industry had quietly known for years. Private credit assets are illiquid. You cannot sell a direct loan the way you sell a bond. There is no public market. There is no exit button. Which means when stress enters the system, rising defaults, distressed borrowers, investors wanting out, there is no mechanism to absorb it cleanly. The fund freezes, the borrower has no alternatives, and the regulators, who never had full visibility into this market, are now trying to map $3 trillion in loans that move entirely outside their line of sight. Meanwhile, default rates in private credit climbed steadily through 2023 and 2024. Leveraged loan default rates hit levels not seen since the post-financial crisis recovery. The funds sitting on those losses are not required to mark them to market, meaning they don't have to report the damage until a borrower formally defaults. The losses exist, they are just not visible yet. And that is exactly what makes this dangerous. If this is the kind of story you want more of, subscribe. New videos every week. The ledger stays open. So here's what this means if you work for a mid-sized company, a regional freight firm, a chain of clinics, a distribution center, a manufacturing plant with a few hundred people on the floor. There is a real chance your employer is carrying private credit debt at rates between 9 and 12% right now. That debt does not appear on any public filing. It is not in the news. Your HR department does not know it exists. But the CFO does. And the CFO's answer to a $2 million annual interest increase is not abstract. It shows up as a hiring freeze, a benefits reduction, a round of layoffs framed as restructuring, a location closure explained as a strategic realignment. If you have watched your company quietly shrink over the last 2 years, fewer managers, slower raises, benefits that used to exist and no longer do, the explanation may not be inflation. It may not be a bad economy. It may be a loan your employer took out in 2020 when the math looked clean, and that the math no longer supports. Here's what the ledger says. Private credit did not appear out of nowhere. It grew because banks pulled back, regulators tightened, and mid-sized businesses still needed capital. The funds that stepped in took real risk and charged real rates for it. That is not a scandal. What is a scandal is that $3 trillion in American business debt now sits in a market with no public transparency, no federal backstop, and no structural mechanism for absorbing distress. When that market corrects, and markets always correct, the people with the least information will absorb the most cost. The fund managers already got paid. The institutional investors already understood the risk. The worker on the floor, the one who never heard the words private credit before today, is the one who will feel it first and last.